Budgeting for capital expenditures involves extremely large amounts of money. So there's a tremendous amount of risk involved. There are uncertain outcomes. There are very large investments. We're talking about those plant assets and possibly natural resources, things along those lines. These are long-term commitments based on future predictions, and it may be difficult or impossible to reverse once we've entered into those agreements if it turns out to be a bad investment. So we want to analyze everything. There are tools that can be used in managerial accounting: the accounting rate of return, the payback period, the internal rate of return, the net present value, and profitability index. So looking at each one individually, this will not give a guided example. It's just going to give an overview of the different methods. The accounting rate of return, it's what is your return on your average investment. So you're thinking of what is your average rate of return. This is how it's sometimes called. It's a fairly simple calculation because it ignores the time value of money. So how do you do it? You're going to take your annual after-tax net income and divide it by your annual average investment. And it's a simple average. It's not going to be weighted. You take your beginning book value plus your end-of-life book value, and keep in mind that's going to be your salvage, which can be zero or it can be what you feel you can sell it for at the end of its useful life. Take those two, add them together, and then simply divide by 2. It's just a simple average for your denominator. Another way you can think of this is what is your average profit divided by your average investment. And again, don't forget salvage. So the payback period. How long in time to recover your investment? You're spending money, how long until you can get that amount back? Because of course you want more than that if you're investing in something. The payback period is considered the break-even point for capital expenditures. So think about cash back. You spend $100,000 for an asset. How long until you can get back that $100,000? And then hopefully anything additional on top of that. It does ignore accounting accruals, and it is a fairly simple calculation, and it's expressed in time, usually years. You want to focus on the cash payback. You're not looking at a time value of money. It's the actual cash. So you take your cost of your investment, the actual, how much did you pay for the asset, divide it by your annual net cash flow. So you've got to make a distinction between net income and net cash flows. It'll not be the same, usually. It's the amount of cash expected to flow in from the investment. It's expressed in years. And again, it does ignore the time value of money. A drawback, it ignores cash flows after the payback is reached. And why is that important? Well, you could be comparing two projects, trying to determine which one you want to invest in. Looking at just the payback periods, what if one looks better, but any money beyond that, let's say the one that looks better, there's really only another $100 expected to come in. The one that may take longer to reach payback, but beyond payback period, another $1,000 is going to come in. So those are the kind of things you have to consider. You have to look at everything. It does ignore opportunity cost. It is how long for the investment to pay for itself. The next one, the internal rate of return, it's usually best to use Excel when calculating this. It's the rate of return to equal a net present value of 0. So what is a net present value? Well, that's coming in a few slides. So this one does involve the time value of money. What's the investment worth today? That's what we're looking at, comparing these. And it's also sometimes called the economic rate of return. To calculate it by hand, it's usually trial and error. The first step, the amount invested, divided by the net cash flows. Now, think back to the payback period. This was virtually the same calculation, only with the payback period, we looked at the answer as expressed in time. With the internal rate of return, you could really take that calculation, only now, instead of thinking time or years, you're thinking of that as a specific table value. Next, you're going to review the table value for the approximate percentage. And this is why it's trial and error. You have to kind of scan the tables to determine the approximate internal rate of return. That's why it's best to just use a computer program to calculate this. The IRR is the percentage earned on the investment. It ignores external factors such as interest rate fluctuations or inflation. So every method has its benefits and they have their limitations. Another easy way to remember this, and it's probably a good way to think of this, the investment return percentage is the return you need to get to equal a net present value of 0. You may hear terms, the hurdle rate. This means it's the minimum accepted rate of return. The cost of capital is your hurdle rate. So think of this. If you spend $75,000 on an investment, your hurdle rate, you want to at least get that much back. And of course, hopefully more, but that is the term for that is your hurdle rate. You've got to get to that point. The cost of capital, it is an advanced finance topic. You can study it in a business finance class, a managerial finance class. This is a term you will hear in those classes. So this is just an introduction to a little terminology on capital investment budgeting. Again, try to remember the IRR is when the point where the net present value equals 0. Now, if the IRR is greater than the hurdle rate, then of course you want to accept the project. If it's less than the hurdle rate, you want to reject the project. But what if it equals? Well, the rule is you should accept the project. And why? Well, if you don't accept a project and you end up laying off temporarily or even permanently some of your employees, and then another project comes along, you'll have to turn around and advertise and make job postings and go through the interview process, which can be costly. Background checks sometimes have to be done, and that costs money. So it's better to keep your employees working even if the internal rate of return equals the hurdle rate. You can almost think of this as the break-even point. You're not making a profit, but you're not making a loss. You're breaking even. You keep operations going so that you have the staff ready in case a sudden new project comes up. So comparing, again, these two, this is a simplified way of thinking of this. It's not going to be exact. You should use some type of computer program to calculate an exact internal rate of return, but this is a simplified way of remembering this. The payback period is the cost of the investment divided by the annual net cash flows. The internal rate of return is the amount invested divided by net cash flows. It's how the number is expressed. So let's say payback period ended up 2.3 years. Getting the internal rate of return, take that 2.3, scan the time value of money tables, and you will come up with an approximate percentage for your internal rate of return. Net present value. This is the most common finance calculation tool. What is the proposed investment worth today in today's dollars? Because we're thinking cash flows. It is a time value of money tool. The expected cash flow in the future from an investment, you want to bring the future cash flows back to the current value. And this is a tool where you're going to be comparing to at least 2 or 3 projects. You want to calculate what is that net present value. And of course, you want to take the highest. Even if you have even cash flows expected every year, you're going to use an annuity table. If they're uneven, it's going to take a little more math, not much, but you're going to have to use the present value tables because of those uneven amounts. But if you have an even cash flow, that is an annuity, and it's a very fast calculation using the annuity tables. You're going to subtract the initial investment from the present value of the future cash flows. So you have cash going out for the investment, then look at your expected cash flows in the future bring all of those back, those future cash flows, what they're worth today. So you have cash out, expected cash in at today's dollars, and don't forget salvage. That salvage value is a future cash flow, at least an expected one. So that also needs to be considered in this calculation. So you start with a negative number, the cash outflow, the positive numbers, the cash inflows, add them together, and that is your net present value today of the project. So looking at various business decisions, if the net present value is higher than zero, of course you accept it. If it's less than zero, you would not want to accept it. That's going to represent a loss for you. You're spending money and you're never going to recoup the entire amount based on the net present value calculation. But what if it equals zero? Same with the IRR, you accept it. Same logic. You want to keep your employees working in the event another project suddenly comes up, so you have the staff available. And in the end, it will cost you less money to keep working on a project with a net present value of zero. So you accept it. Final one, the profitability index. We're looking at the net present value of cash flows divided by your investment. And of course, the higher is better. Now to review the time value of money when you ignore it, the tools is the payback period. It's the simplest method. It ignores the cash flows after the payback. It's measured in years or time. The accounting rate of return is also another one where you do not use the time value of money. It uses accrual income instead of cash flows. It's the average return on the entire investment, and this is an estimate. It ignores the annual rate over the life of the project. That's the problem. And it is measured in a percentage. So these two tools that ignore the time value of money, they have benefits. They also have some limitations. Now the tools used when you do use the time value of money, the net present value, you are able to apply this to uneven cash flows. If it's an even cash flow, you can use the simplified method, the annuity table, but if they're uneven, you can calculate the net present value using the present value of one table. It does consider changing risk over the project life, but the comparison is limited with uneven project values, and the measurement is in dollars. The internal rate of return also uses the time value of money, considers all cash flows from the project. The percentage calculation allows comparison of different sizes. So just like with financial accounting ratio analysis, when you convert dissimilar things to a percentage, one company is very small, another one is a huge conglomerate. You can compare the two if you convert to percentages. Same with these capital budgeting tools. It is measured in a percentage. And those are the capital budgeting tools. And